Uh, Welcome everyone, and thank you for joining our first webinar for clients. So without any wait, let's just jump into the presentation. So let's start with what we said on 23rd December 2025, and then we will take it on from there. So what was our conclusion slide at that point of time? Central banks are now extension of the government with limited independence. Watch what they do, not what they tell you. I'm pretty sure you would have seen a lot of instances of that in Western world in the last 4 months. AI is a bubble, but if you want to participate in it, do so through the picks and shovel approach. That's what we've been doing. The US is no longer willing to bear the burden of policing the world and sharing its GDP with the rest of the world. The world is rearming and military spending is now on the rise. I'm pretty sure it is clear to everybody now. Western world is facing a sovereign debt crisis and governments are likely to inflate away their debt. More Some more slides on that thing later on. Lower bond yields and higher asset prices are a matter of national security in the United States. You can see it. This is happening in front of us. Focus on assets that benefit from nominal GDP rather than real GDP and favor high fixed cost businesses over high variable cost businesses. If you've been investing like this thing, whether even in India also, I'm pretty sure you would have done very well. We might see two separate monetary systems within 5 years. The US umbrella will rely on stable coins, while BRICS plus countries will settle their trade balances using gold. A lot of noises over there. Clarity Act will pass in United States. Stable coins will get much more clarity in the coming days in United States. India's nominal GDP settling below double digits is not good news for Indian equities. The new normal for India's nominal GDP is 10%, not 14%. Invest accordingly and temper your expectation. Let's start with our view. So our short-term view is blurry. Why the short-term view is blurry is simply because of this Iran war uh, and the closure of Strait of Hormuz. Why is closure of Strait of Hormuz so important for everybody around the planet? Less so for US and Russia, but for everybody else, it's a nightmare. Why? Just see we all know about the 20% of oil passes through Strait of Hormuz, which is basically 20 million barrels per day. But more than that, just look at what everything else which passes through Strait of Hormuz. Methanol, ammonia, helium, sulphur, fertilizers, ammonia, urea, LNG, crude oil. So crude oil, everybody knows crude oil, 20-25%. But look at the other things also. It's like a lot of things passes through Strait of Hormuz. And if they do not reach their destination on time, you know what can happen. And I will talk more about, some of the things which have started breaking down, some of the supply chains which are breaking down. And on the right is the impact of, some of these commodities in the last 2 months. You know how the prices have risen, uh, whether it is crude oil, which is very clearly evident on your screen. But in my mind, there is a heavy hand which is not allowing oil prices to rise. But something like urea, fertilizers, you know how the prices have gone up. This is a very interesting chart from FFTT. The current world population and the world population, if there is no urea available, if there is no nitrogen fertilizer available in the world. So half of the population of the world depends upon nitrogen fertilizers. Basically, we can talk about urea. So the urea laden ships, 30% of all the urea passes through Strait of Hormuz. Basically, no urea has passed Strait of Hormuz in the last 2 months. Uh, and the impact, we've just started seeing the impact now. Yesterday, wheat prices in US, so this was wheat prices have risen highest since 2024. This slide is just 4 days ago, but day before yesterday, wheat prices were up almost 8% in US, simply because they are going to have the lowest wheat crop in the last 50 years. So on the margin, supply chains have now started breaking down. Why they have started breaking down now? Because if there is a tanker which has passed through Strait of Hormuz 50 days ago, 60 days ago, has just reached Europe last week. So till last week, they did not need to do anything. They were still getting their cargoes. But the interesting thing is, market is not worried about oil. Market is not even pricing that oil prices means anything to the market. Everybody I know talks only about semiconductors. In fact, you'll be surprised that Exxon, the largest oil company in the world, whatever was the stock price before the start of this conflict, in fact, today the prices is lower than what it was before the start of the conflict. On the right is a chart, a very interesting chart that we are running down on our inventories. In fact, whatever were the floating inventories, whatever the excess oil was there, we are absolutely running down dramatically. And that's why you've not felt the impact, at least in crude oil till now, in some of the bigger countries. Smaller countries have already started seeing rationing. India, you've started seeing some rationing. Uh, Thailand is the first one to sow the crop, and they are finding that they do not have enough fertilizers, so they've not been able to sow the crop this year. So on the margin, things are actually breaking down as of now. There's one more chart that make you go hum. What is technology used for? Actually, technology is used for reducing the cost and increasing the productivity. This is the first time in the history of last 65 years that the cost of technology is actually more than the wages which are being paid to the people. So this is very interesting, which is happening, that the cost of compute or whatever we talk about in everything part of technology is actually much more costly than human beings for the first time. On the right is the GPU availability. Actually, I missed this chart. And this was very important chart. There are absolutely no GPU available in market at this point of time. That was 15 days ago. What you are seeing the lines, going down, it is actually, if the lines are going up, that means the availability is there. If the lines are going down, different kind of chips, different kind of GPUs, which are available in the market. So the availability has actually come down dramatically of GPUs in the market. Uh, I'm sure people who are from India remember the Reliance Power IPO. That was what created the top in the market. Then we remember the Saudi Aramco IPO, which was the biggest IPO in the last 6 years, I think $20 billion. Market topped out within a couple of months. We do remember the Petronas Tower in Malaysia, the biggest tower, Burj Khalifa in Dubai. Now we will be having the biggest IPO of our lifetime next month with SpaceX. SpaceX will be taking away almost 85 to 80, 75 to $100 billion of liquidity away from the market. So this is a great chart that whenever there is the biggest IPO of all the time, market tops out at that point of time. So I'm just sharing this chart with you. This is a very interesting chart. On the right is the Meta 5-year CDS. Now, of all the capex these hyperscalers have started doing, Meta is the first one which has started seeing the stress. Today, the 5-year CDS, credit default swaps of Meta, is equal to 80, 85 basis point. If you're saying which country is at 80, 85 basis point, actually Indonesia is at 85 basis point. So Meta's 5-year credit default swap is almost as equal to the credit default swap of Indonesia. So that is a credit worthiness which market is saying for a Meta 5-year. For they are willing to pay that kind of cost as a default risk for Meta. So UK yields have touched 5-year high now, UK 10-year yield, and US just borrowed 30-year money above 5% yesterday. When was the last time they borrowed money above 5%? It was in the year 2007. So after 19 years, for the first time, they are borrowing a 30-year money above 5%. So this crisis is hitting uh, countries like India in a different way. This crisis is hitting Western world through bond market. If the bond yields continue to move up, in an indebted world where Western countries are very much indebted, where everybody's having a mortgage, I'm pretty sure the pain is being felt differently in the Western world, including United States. But we only come to know the pain which you can see from the eyes, which you can see it from the announcement which is happening in India. But I'm pretty sure Western world is also in a deep trouble because the bond yields are rising. Even German bond yields are rising, Canadian bond yields are rising. So there is bond is the first place where this stress is coming out. Now, if some of you are investing in US, then US is having 11 subsectors. This is 1 year chart of 8 subsectors, which are more important one. The three are also having the same kind of chart, except for the technology. Just look at technology. This is 1 year chart. Technology, energy, financials, materials, industrial, real estate, consumer staples, utilities. Except for technology, all the other 10 subsectors in United States are actually having the same kind of charts. They're all going negative. In emerging market ETF, uh, Alibaba, Samsung, and I think TSMC have delivered 105% return of emerging market ETF. That means every other 2000 stocks put together have given a minus 5% return. That is year to date. So you can see the only game in the town is actually AI. And since more and more fund managers, more and more investors like to chase momentum, they are selling whatever they are having, irrespective of valuation, to just chase technology in technology. And you would be very interested to know that company like Microsoft is at 2 years low. Company like Meta has not gone anywhere for the last 1.5 year. So the rally is much, much more narrower. And it is obviously more towards the AI, more towards the memory chips of South Korean company SY Hynix and Samsung. So the profit of SY Hynix and Samsung's this year will be equal to 3 times the profit of Nifty 50 companies. But the long-term view is clear. So I do see these short-term things happening. 3 months in a year, I do go through this period of stress where I look at and I said, what am I not understanding? What are everybody around me is understanding? Everybody's chasing this momentum. What am I not able to do it? Every year I do go through this 3 months of stress. But at the end of it, you come to know that that was only a passing phase. So I would still call it a passing phase at this point of time, but let's go back to our long-term view. This is where we are invested. The investment map is being redrawn. Every action has a reaction. I just wrote it 1 month after the Iran war. On the left is global supply chain stress index. When the stress index is rising, that means countries are thinking of reshoring their supply chains. When the stress index is low, you can see from 16 to 2020. Then you can see the 21 bump and then it went down. Then it is moving up again. I believe we are moving from just in time to just in case across the world where countries will double down on the other side of this war, as I write. The investment map shifts. US double down on securing critical materials. China doubles down on energy security plus chips. India doubles down on energy plus chips plus critical materials. So here is your investment thesis for India. Middle East doubles down on its defense. Europe still debating its doctrine, but they've started doubling down on their defense. So this is a playbook for investing in the brave new world. And this is how we would like to invest. And this is how we've invested. So although we've not participated in any of this memory chip or AI hardware, uh, in the last 1 month, we are still beating our benchmarks handsomely. And in those benchmarks, 40% is actually AI. So this is European defense. Look at the orange line. The line which is rising the faster is the one where you will see the maximum amount of money being spent. US is a behemoth. It is already at $1 trillion on the defense spending. So the incremental delta you will see will come out from orange line and this gray line. So I would say that Europe and Asia is where you will see the maximum amount of defense spending. So this is where we would like to position, and we are positioned at this point of time with a pure play of European defense ETFs. You've heard about our views about uranium, basically nuclear energy. And we've seen a lot of progress about nuclear energy across the world, including India. After this war, when the war started, that is where we started investing in solar and lithium also, because I realized that more and more countries will not stop at nuclear energy. They will go for every other alternate energy source which is available to them. They will double down on that. And that is why we invested in solar and lithium. Both of them have done very well since the war has started. And I believe that even if the war stops tomorrow, that we will continue to see massive investments from countries around the world in this, in all these three sectors of energy security. You've heard about electrification as a macro theme of the decade. So I just wanted to put President Trump has just invoked wartime powers to fund new energy projects. So this yellow-green line is actually the electrification ETF, and the blue line is S&P 500. Just mind you, S&P 500 still has 40% in technology. So in spite of S&P 500 having 40% in technology, grid ETF is having 0% technology. Grid ETF is actually beating S&P 500 handsomely in the last 1 year. In fact, if you go back 2, 3 years also, it is doing really well, but it has started picking up momentum in the last 1 year. And so for us, when we say that how we invest, invest through picks and shovels. It's the same way like in an AI model. I do not know which model will be the winner, but I do know that all of them will be spending on compute power. So that is how we like to invest. And this is just an example that this is where we are invested currently. And one of the largest holding is actually grid ETF for us. Now, very interesting things are happening in this war. If you look at every other previous war, then money has moved from rest of the world into USD, strengthening USD versus other currencies. And money has moved from rest of the world bond markets to US bond market, bond yield, and the bond yields have gone down. This is the first war in the last since 1990. I have the data since 1990. This is the first war where US bond yields have actually gone up and US dollar is not finding any bid at this point of time. So you see that circled one is the 2026 Iran war, and that is a complete outlier in terms of money moving into US. So there is no way that money is actually not moving back to United States. And then that's why you are seeing their bond yields are rising. That's why you are seeing the dollar is not seeing any bid. So something is changing. Something is changing. US is no more the safe haven what it used to be for the last 30, 40 years. An interesting chart. US is a service-led economy. Manufacturing is only 10% of the GDP. Orange line has always remained above the blue line. What is orange line? Orange line is the US service PMI. Being a service-led economy, obviously services are much, much more stronger. Blue line is actually the US manufacturing PMI. What we are seeing currently, just look at the last part of this chart, where US service PMI is at 54, falling, and US manufacturing PMI 52.7 and rising. I believe it's a matter of time that this blue line will cross orange line and on the upside. And that is where That is why I say that US manufacturing, which is currently 10% of the GDP, and almost a $30 trillion economy, in my mind, I'm visualizing, can it go to 11 or 12% of the GDP on an expanded base in the next 5 years? So this is a bet that, I have it in my mind, and this is how we are invested. I would like to say that, there are people who are skeptical about that, US will not be able to get back its manufacturing. Possible. But I strongly believe that more money is made in journey than the destination. We do not know the destination, whether US will reach that destination or not. The same way India is also trying to do. India's manufacturing is 14% of the GDP. Can anybody visualize that over the next 5, 7 years, can we go to 16, 17% of the GDP can come from manufacturing? If it can, then you have new winners which are not there in the benchmarks. As I said, AI is the only game in town. This chart is very telling. US goods import in US dollar, annual growth rate. Just see the growth rate in AI related goods import is 80%. For everything else, it is negative 25%. If I would take AI out of picture, then US is actually having negative GDP growth also, even the negative GDP growth. So what you are seeing is because of advanced tax depreciation, massive amount of money is going into this particular sector. So this is the only game in town. Uh, we wish that we were having a little bit more exposure in some other way. But then, I've seen this thing many times before in my last 26 years career that you need to everybody need to chase the shiny object, because otherwise then they start losing the AUM. So on the right, AI spending set a record with no end in sight. AI spending boom, AI capex risk. Everything else, everything is only AI related. Now, this is a low probability, high impact, and outcome nobody has modeled for the first time in the last 10 years. Uh, S&P 500 employees have actually fallen, number of employees data. But on the other hand, which I'm also finding interesting and I'm also using it, AI is very productive, very productive. I can assure you that the way which we are using is we are just scratching the surface, but we are finding that our productivity has gone up. So US business application is going up. On the right, bottom right is how AI helped one man build a 1.8 billion company. It was Naval Ravikant, which said 3 years back, we will have $1 billion company with one employees, and that came right just this year. So AI is a very, very big in productivity. So I believe that, but will the productivity kill the job growth? I do not know. But for people like us, I can assure you that within a year, we will not require research analysts at most of the AMCs, most of the mutual funds. It is just not required. Provided the AI model does not lock me out every two hours because I'm using my team using a lot of compute power. That compute power should remain cheap enough for us not to hire people. These are the bullish themes where we are invested. Just look at market cap to GDP of LATAM. It is just 42%. So on the right is LATAM stocks are after a long period of time. I think it was 2007-8 is when we saw LATAM stocks are breaking out versus US stocks. Uh, I'm pretty sure over the next 3, 4 years, everybody will know what is Wakamuta. The same way they knew, what is US shale basin or Permian basin. Wakamuta, in my view, is the next big shale basin in the world. So next shale, supply will come not from US. US shale wells are actually peaking out, but the next one will come from Wakamuta, which is in Argentina. It is possible that Argentina could be exporting 3 to 4 million barrels of oil from Wakamuta alone in the next 5 years. So that's why we continue to be bullish on Argentina. And it has other agriculture commodities, etc. On the right is, people don't talk about Brazil much, but Brazil has 13% interest rate. Their currency is one of the strongest currencies this year. They have 25 rare earth metals, and they are having all the facilities. They are putting all the facilities in Brazil itself. It's just that they have a presidential election this year, so that can be an overhang on Brazil. So we have a small one in position in Brazil, and we are waiting to increase our position in Brazil. This is a chart I got it from North Star charts. I'm not good at charts, but there are some people who are really good at charts. These are the people I'm reading for the last 5 6 years on Twitter. So I do not put anything out unless I myself have been reading them for a long period of time, and they've been more right than wrong in the past. So this chart is very interesting, where they say every time this blue line crosses the red line from below, then at that point of time, precious metals, commodities, energy, oil massively outperform stock markets each time with hundreds of gains of hundred of percent. So just leaving this chart with you, because fourth time in the history is in the last 100 years. This is the fourth time in the history that we've started seeing this kind of phenomena. Obviously, 1970s, everybody know about it. 2000, we know that 2000, when the tech bubble burst, what happened for the next 7 8 years. 1970s was all about that stagflation. So they are seeing this signal for the fourth time in the history. So just leaving it out with you over here. One of my friend is a vaccine scientist. He was actually instrumental in developing the COVID vaccine. And when I was having a discussion with him, possibly 3 4 years back on a hike, he told me that these vaccines were not made for healthy people or for babies. These vaccines were made only for old people. But then uh, pharma companies became greedy, and then they started injecting uh, this vaccine to everybody. And he told me even at 3 4 years back that what you will find in the next 5 years is massive side effects, a lot of different disease coming out, because we do not know what will come out of it. It was not properly tested. And then I started following something on what is going on in cancer. If you read what is going on in cancer, cases are going through the roof across the world. US is the best example because US, the data is very easily available, and it's a good data actually. So I'm actually amazed at that people are just not looking at this problem. Now, I don't like to say that, obviously it's a bad disease, but but here is a oncology ETF. We've just added a position in oncology ETF in our portfolio. And because I believe over the next few years, cancer is going to become a much, much bigger disease than what we currently have. And there is going to be massive spending on this particular disease going forward. Let's come to India. I have three charts on India because people keep on asking about India. Although we do not invest in India, we are not allowed to invest in India because it could lead to round tripping. You taking out money in USD and investing in India through USD ETFs, so that regulators don't like it. The blue line is actually your India's market cap to GDP, and on the yellow line in India's nominal GDP. Do you see the problem over here? That our nominal GDP has collapsed, but your Indian market cap to GDP continues to be high. So this is the difference, is the problem which is having our GDP. Our nominal GDP used to be between 2013 to 2023. Our nominal GDP growth rate was around 12% on an average. After 2024, our nominal GDP has actually collapsed. This 2021, what you are seeing was just a COVID. Otherwise, 2013 to 2023 was a great time. Now our nominal GDP has actually come around to 8.5 to 9%. It is now below 10%. But the market cap to GDP continues to be high. That means our valuation continues to be very high. How can I give the same kind of valuation multiples to an economy whose nominal GDP growth rate has collapsed from 12% to 8 or 9%. So that is a whole problem with India. But I do believe by next year, India's nominal GDP growth rate can easily go to 10.5%. And that is where you might see that a 10.5% nominal GDP growth rate will be good for some sectors. So this is a problem. This is just a simple problem I'm explaining about India. This is the next big theme which I have started talking about. Uh, from South Korea to Taiwan to Japan, Germany, Canada, every country in the Western world, every high income country in the world and war zone in the world requires people. Their love affair with unrestricted migration of the people who do not, assimilate in the society is over. Japanese Prime Minister today said, if we do not get the right kind of people, we are okay with a population collapse. She said that thing. I'm strongly of the opinion that India's demographic challenge is going to become a massive demographic dividend. And over the next few years, India will be exporting huge quantity of blue collar workers, and white collar workers will be left back in India because nobody wants white collar worker across the world. We have abundance of white collar worker and we have shortages of blue collar worker in the world. So that is why I believe that, over the next 5, 6 years, uh, if you are advising somebody, advise them of doing a trade skill, get some, become have some skills, real skill rather than being a laptop worker. And I believe that in the next 5 years, you will stop getting a good carpenter, plumber, electrician, or even a driver in India. If you are used to them, then you better hold on to them and give them enough money. Otherwise, they will move on to the rest of the world. Plus, all the war-torn zones will start seeing a lot of migrant worker from India going to those workers to rebuild those economies. So just keep this thing in mind that if there is a reskilling startup also in India, they will be doing really well. Now, my view on market, I have not changed any of my view about India. I gave this view 2 years back to NDTV profit. Below are my tweets from 2023 we picked up. There are only four themes which I am bullish on India and continue to be bullish. These are the only one which I ever invest in because I strongly believe Indian benchmarks do not represent uh, future of India. So I'm bullish only on electrification, defense tech, tourism, and wealth management in India. The only thing which did not work for me was tourism, simply because tourism was supply constraint. Electrification worked beautifully. Defense tech and engineering services done very well in India. Wealth management has done very well in India. So I would continue to be invested in only in these themes in India rather than going into the benchmarks. 50-55% of our benchmarks are actually service led. When India's prime minister and US president says that they want to rebuild, they want to have supply reshoring, they want to be energy, they want to be energy surplus, they want to have energy sovereignty. They are telling you that they are talking about investing money into, or they are pushing companies to invest into manufacturing, not in services. Even today's software companies, the mega cap tech companies which we are talking about, they are becoming asset heavy companies rather than asset light companies. So I think over the next few years, we will continue to see the same theme. So in 2 years, we've seen massive, possibly 2, 3 years, we've seen massive move in some of these sectors. I still believe that over the next 2, 3 years, these sectors are really good in my view to continue to remain invested. Now, this I picked up from last week's 13D. They are very good in some of the longer term, thought processes. So they believe a super El Nino is coming, and India is in the middle of that. The upcoming super El Nino may be stronger than the one that caused the Great Famine of 1876 to 78, which led to the death of over 50 million people. This super El Nino comes on top of soaring fuel and fertilizer prices, risking a multi-year global food crisis. So they also write that what happened in 1876 to 1878, when British journalists walked the streets of Bangalore, India in August 1877, he found an average of 20 dead people each day. The strongest ever recorded El Nino occurred between 1876 and 1878. It caused the southwest monsoon to fail, leading to widespread drought and crop failures that led to an estimated 11 million deaths from famine and disease. So I'm not scaring you over here. I'm just putting something over there that this that India could see really, agri inflation is one of the worst inflation anywhere in the world. India is in the middle of that this year. How to invest in the brave new world? This slide has remained with us for a long period of time. If any of you want that slide, the team will have it. But this is how we invest. This is how we invest in the brave new world. And I'm not going to repeat that thing. If you want, you can just go through it. Just keep it on over here for a minute. Okay. Few days back, I was talking to the Washington Post, and I just said, we know supply chains are breaking down in Asia and even Europe. We know the correction is eventually coming, but everybody wants to live the present moment. That's what I see it on an everyday basis. People are just saying to themselves, they will solve these issues. And if they don't get solved, we will sell at that point of time. So we have to dance while the music lasts and hope you are near the exit door when it stops. So I have seen this lesson before that, even though, let's say I'm a bearish or I'm not able to understand that thing, I would still like to participate and build up the knowledge that what will be the signals where I would like to exit at that point of time. So we've been participating in a lot of these things in the market. So I'm in that exact situation, despite talking to people in the background who know something is going to break. So a lot of people, I talk to smart people who says something is breaking, it doesn't look real. But then the thing is, realities markets are up, at least for this month. And we are just today touching again back to 50,000 on Dow Jones and 7,500 on S&P all-time high. So what is the market outlook? Markets are not pricing in the real risk of prolong the Strait of Hormuz closure. Either they know something or are being managed or are simply irrational. The Strait of Hormuz remains partially closed. This is an availability crisis, actually, not just a price shock, making it much more dangerous than the 1970s oil crisis. AI is here to stay. It's the only thing currently keeping markets afloat. The Fed is accommodating energy shocks for now, fueling the AI bubble and increasing the money supply amid rising M2 money velocity. So I'm seeing after a long period of time that it's not only that the M2 is rising, it's the M2 money velocity is also rising dramatically along with M2. Energy independent emerging markets are outperforming and are likely to continue doing well. And that is where Latin America fits into the picture. Agri and energy independent. A global recession is likely by 2027, driven by high energy prices, commodity shortage, and weakening household income. Europe is already heading into one. Yes. So what you are seeing currently is because of accelerated depreciation, massive amount of AI capex is, which has been borrowed from the future. So in the future, we will not have that kind of AI capex. And at that point of time, we might have a weakening of economy and possibly a global recession. I also believe that, till midterms this year in US, they will try to keep the economy, even if it goes into a little bit of slight recession, they will try to pump the money back into the system. It will work till the time it doesn't work. India's nominal GDP could climb back into double digits by next year. We continue to remain bullish on electrification, engineering services, and defense in India. Yeah. So this is the end of presentation.
Thank you, Ritesh, for the insightful presentation. We can move to the Q&A segment of the webinar. So we received a number of questions from our investors before the session, which covered various topics regarding global macros, geopolitics, AI, emerging markets, and India. So without wasting further time, the first question is, what would be the implications of a closure of the Strait of Hormuz on global supply chains, inflation, and the broader economy? Just to follow up on that, what percentage of global oil production and transport infrastructure has been disrupted during this war?
So I have already shared one slide on that particular aspect. People only look at oil prices. Oil is 20-25% of that passes through Strait of Hormuz. But it's not oil alone I'm worried about. It's about everything else. It's like ammonia, sulphur. You require in very, very small things. What and that is what you'll come to know in the next 3-4 months, what has broken down. Okay. So and I'm seeing already signs of that there is no urea. India is buying fertilizer 100% higher prices. Oil prices, which you see on screen, are completely disconnected from the real oil prices which you are getting. If you have to take longer routes, then the number of ships remaining the same, then you require double number of ships for the same cargo. You'll start seeing all these things in prices in the possibly coming days.
Thank you. The next question is, you've often said that central banks are now an extended arm of the government. Given the sticky inflation in the US and globally, is there a possibility of Fed rate cuts given President Trump's hesitation to increase interest rates in the future?
So rate cut is very difficult at this point of time. What they will do is they will take some other kind of measures, like they might come out with uh, yield curve control. Like they're not allowing 10-year to go beyond 440 for a long period of time. Yes, we are at 443, but every time it goes to 440, there is a heavy hand of market on that, heavy hand of somebody on the market. So they will do something like that. On the other hand, they will do something for housing related through Freddie May or Fannie Mae. So what you will find is that more and more the your signal from central bank will be reduced. Fed will stop mattering less because they will try to manage the economy or sectors where they want money through administrative, through regulatory measures rather than Federal Reserve Bank. What is the point of Federal Reserve Bank if they raise the rate or cut the rate, but the 10-year remains at 440? It doesn't matter, no? But if a 30-year housing mortgage, which is currently at 6.5%, they come out with measures. No, anybody can get a 30-year mortgage now at 5.5%, which will be subsidized by Fannie Mae or Freddie Mae. Then isn't it a 100 basis point rate cut for that homeowner, right?
Mhm.
So we are now getting into a world where credit will be rationed, even in India, rationed according to what government thinks is the sector they want to give it. So if they like a sector, they think that they need that sector to grow, that sector will get funding much cheaper. And if they do not like a sector, they will make it difficult or increase the costing for that sector. So what is the point of having a Federal Reserve at that point of time?
Thank you. Moving more to the themes of Pinetree Macro, the current theme is to play a picks and shovel strategy.
Hmm.
However, if there is a bust in AI firms, could that
Hmm.
negatively impact the picks and shovel strategy as well for the fund?
So it could in the short term, but electrification is not only electrification theme started even before AI. AI actually accelerated the electrification theme. Think about if US wants to have a manufacturing boom, it wants to reshore its supply chain. US is having a very light electricity grid. Means it is only for service-led economy. They never needed a heavy electricity grid. Today, actually, they need a heavy electricity grid just even to manufacture anything. Even to have new plants coming into United States, they also need heavy manufacturing grid. But yes, there could be some kind of disruption in the short term, but electrification as a theme is a little bit longer term than the AI theme.
Just building up on that question, one of the themes of Pinetree Macro is reshoring as well. Given that we have a midterm coming up, how confident are you regarding the reshoring theme going forward, given President Trump's ratings leading up to the midterm?
Actually, reshoring theme plays for him because Rust Belt is or MAGA or his voters are the ones which wants their jobs back. These are the people who are from Belt which have voted for him. People from New York don't vote for President Trump. People who vote for President Trump are the ones which you don't see on your screen. They are the ones which are happy with a job, which is a secured jobs kind of thing. And that means we are actually seeing a lot of renaissance in old places like Detroit and all, which have already fallen to bad times over the last 20 years because of you know, the jobs moving to China. We saw that thing. Now those jobs, if they want those jobs back, it will be coming in the same places. And they are the ones which are voters of President Trump. Look, people don't care about inflation as long as they have good paying jobs. So wages are rising in United States.
Thank you. And given the geopolitical tensions that are going on right now and the volatility that we are seeing in oil prices, what is your view of emerging markets? And do you think it makes sense to allocate capital to emerging markets at this point in time?
So there are energy independent emerging markets and there are energy dependent emerging markets. If you are in emerging energy independent emerging markets, which are also agri positive, means which are agri producer, Latin America is a great example for that. I would prefer to do that thing. But for anybody who's energy dependent and also do not have any AI, global capital will not go over there.
Okay. And moving to commodities, what currency do you feel is best to buy gold in? You've often spoken fondly of the Singapore dollar.
Yeah.
And what is your current view of gold, silver, copper, uranium, and gold and silver miners?
So I would prefer to buy only in Singapore dollar. If you are asking the one currency where I would like to buy gold, it will be Singapore dollar, then it will be Swiss franc. What we are seeing currently is that money is moving to AI theme. So every other sector is being sold to buy AI because a lot of hedge funds which did not participate in this thing are, so one hedge fund yesterday closed one AQR because they did not participate in this theme and they shorted this theme. So everybody, it's like the mentality. If you're not participating in this theme, then you will lose money. So that's why everybody is now participating in this theme. So that, and that is what is sucking away money from rest of the market. But having said that thing, I believe we are going through a time correction in gold and silver. Copper has already broken out. Copper, nickel, zinc, aluminum, they have actually broken out. Industrial metals are much more stronger than gold, silver. And we do believe that copper has started a big upleg. So we do have copper ETF with us in portfolio. Gold, silver are just going through the time correction in my view.
Okay. Moving forward to the China meeting, which is taking place as we speak, if there is a temporary relief post the China meeting with President Xi and President Donald Trump, or there is a pullback from President Trump or Iran, the world ex-China, Brazil, and Russia will go all out to gather oil, energy, and resources over the next 4 to 5 years. Then will both China and Russia try to gain in AI and claim supremacy over the US, while the US focuses on rebuilding military and geopolitical strength for a future conflict?
Yes, I said that thing. Like US, what will happen on the other side of the war? US will double down on something. China will double down on something. China will double down on AI supremacy. That is the only thing remaining for them.
Mhm.
So on the other side of the war, if something comes out of this meeting, it is actually good for Chinese assets also. People are underinvested in Chinese assets. They do not have any China. They've written off China. In fact, more money today has gone into Taiwan and South Korea rather than China. So it could actually be beneficial for Chinese equities also.
And just a question on India. I know you touched upon it in your last few slides. Small and mid-cap valuations in India are still not cheap despite 2 years of consolidation. What is your view on Indian markets for a 3-year time horizon? I'm convinced on the long-term story, though shaky right now with no AI or manufacturing edge. do you feel that we will be unable to make any progress until structural changes are made to the Indian economy?
So I am not invested in the benchmark. For me, you should not look at benchmark.
Mm.
Any sector which can grow at double the nominal GDP, any sector or any company which can grow the more than double of the nominal GDP will command higher valuation in my view. And that is what you've started finding in SMID, small and mid cap indexes. What you are finding that a lot of the companies are coming from that particular benchmarks. A lot of the companies are coming from that particular indexes. Now, some of these companies are actually getting the global work in India. Some of them is a very small cog in the wheel for the semiconductor or AI related or electrification, all these themes. Even in Indian defense, you have companies doing that thing. Engineering services, they're doing electrification, also the same thing. So I would say that focus only on those companies where you are becoming a part of global supply chain and where India is also bringing back, like India did yesterday something about gasification, cold gasification. So wherever Indian government is spending money, which is not in consumption, if it is not in consumption, then 55% of your benchmark is gone. How can you invest in 55% of benchmark if you're saying no consumption? So I would say that wherever the Indian government is thinking of doubling down, that is where you should be investing. Anywhere where you have the global supply chains, a small part of that work is getting into India, that will do well, with rupee also depreciating at this point of time. And I also believe that finally IT is becoming cheap. This is my view that AI tokens are so costly that there are companies which will start hiring back some kind of human workers. Possibly once we have the data centers in space in another 3 to 5 years, who knows what will happen at that point of time. But for the time being, I believe it is possible that human workers will start. I shared a slide where the cost of technology is rising much faster than cost of hiring a human worker.
And just the last question on India. A lot of investors are wanting to know what is your sort of prediction for INR USD for the upcoming year, given the depreciation we have seen over the last 1 year. We see stress in the market, and Prime Minister Modi has come out recently with an austerity appeal as well. So where do you see the rupee and dollar progressing right now?
So my view was 1992 on dollar rupee uh, before the Iran war. Now Iran, even after Iran war, my view would not have changed had we passed on the oil prices increase, complete oil prices increase. Because when you pass on the complete oil price increase, the demand destruction happens itself. So if Indians continue to buy gold, if Indians continue to buy gold and full oil prices are not passed on, Indian currency will remain under pressure. Let's say if you tell me that Indians will not buy gold, then I would say you will top out around 95, 96 or $100 kind of thing. Bernstein also is having a 96 target. If Indians continue to buy gold, then rupee will continue to depreciate. But think about it. Rupee will depreciate against what? Even Chinese currency is depreciating against gold. Gold prices are rising, right? So they are actually pushing their citizens to buy gold. We are not doing it because we are on the other side. But if Indians continue to buy gold and the love affair with gold continues, then the Indian currency will remain under pressure. And I would not say this is the bottom. Having said that thing, Indian government can always postpone the problem by offering a good enough rate on an India bond where Indians, NRIs flock to India, borrow from their local bank in US or Canada, leverage it and invest in India, and suddenly India gets 50, $75 billion overnight. And the problem is postponed into the future, which we will look after the next Lok Sabha election. That is always possible. Any determined government can postpone the problem, which can print money, can postpone the problem into the future.
And sorry, just one last question. You've often spoken about that there will be two net trade settlement systems in the years to
Hmm.
come, gold-backed stable coins and gold. Where does that thought process come from? And which countries do you think will align to either block?
So US is trying to push stable coins dramatically. All stable coins, the more people buy stable coins, the more will be the demand for US Treasury, because all stable coins one to one is backed by US Treasury. So they want a new buyer for US Treasuries. If Indians start buying US stable coins, basically Indian government will lose sovereignty, monetary sovereignty over its own people. And in countries like Brazil, uh, US stable coins sometimes are traded at a premium. People trade amongst each other. So Indian government, I think the BRICS will completely says, no, we do not want to be part of US based stable coins anymore. We would want to have some other kind of currency. But BRIC is a block of countries which do not even, some of them don't even like each other. But what they have in common is they have almost 70% of the global gold is in BRICS country, household plus government put together. So it is possible that US can have US Treasury backed stablecoin, and BRICS or countries which do are not part of US has gold backed stablecoin, backed by gold. So that is where my two US needs a new buyer for its treasury. Rest of the world doesn't want to put in US treasuries, especially after the Iran war. If they would have won the Iran war handedly down, they would have made sure everybody invest in US treasuries. But by showing the weakness, there are a lot of countries which says we do not want to invest in US treasury. And what I'm hearing is that a lot of countries have not been allowed to sell US treasuries during this last 1 month of stress. So a lot of countries are angry at US. Obviously, you cannot say in public, but they are making their own, we need to do something else.
I think that's all for the questions. Thank you, Ritesh, for taking the time to address all these questions and for sharing such detailed insights with everyone today. I think we can continue this discussion given the depth of the topic and the interest that we have from our investors. But in the interest of time, we'll wrap up the session here today. Thank you, everyone, to all our participants who joined us and for sharing such detailed and insightful questions. We hope today's discussion provided greater clarity on our current thought process, our global macro outlook, and the themes that we see will shape markets over the upcoming quarters and years. We look forward to continuing this quarterly webinar on a routine basis, as it's a way for us to stay closely aligned with our investors going forward. My apologies if there are certain questions we could not address from the participants. We have over 100 participants. However, if there is a question that you would like us to address, please feel free to email us and we will email you back. Thank you once again for your support and wishing everyone a wonderful evening. Thank you.
Thank you. Thank you, everybody.